All right, well, welcome to the Acuma Inside Track webinar, and I'm going to kick it over to Cameron Hinton from Acuma to get us started.
Thank you, Mark. And hi, everybody. I'm Cameron. I am Acuma's Associate Director of Events and Member Relations. I'm super honored to kick off this webinar today, hosted by our friends over at CLASS. We greatly appreciate CLASS's support of Acuma, specifically our Young Professionals Network. So wanted to give a special shout out to that. And again, it's our pleasure to work with the whole team at CLASS and really looking forward to today's webinar. Mark, I will turn it right back over to you to do some introductions and kick it off.
Thank you. Hi, everybody. I'm Mark Walser. I'm Senior Vice President at CLASS Valuation, the CLASS Credit Union Division, and we're joined today by Sally Carruthers, our Executive Vice President, and also two special guests. We have Eric Weekley from Tennessee Valley Credit Union. We also have Misty Goffman, who's joined us from One Arizona Credit Union or One AZ Credit Union. Wanted to make sure that you guys all said hello to them, and they're going to be sharing some great content as well on this call today. We're going to do, just to give everyone a quick overview, this is going to be a high-level webinar on a number of topics that are hitting the industry, and we're going to try to keep it to about 45 minutes, maybe 30, 35 on the presentation, and then we definitely want to leave room at the end for questions and for interaction. I know many of you will have some of those questions not only for us, but also for Eric and Misty as they share. So looking forward to having you guys give us input as well on this. Real quickly, for those of you who don't know us, a little brief commercial on CLASS. We are the largest appraisal management company in the country. CLASS Union is our credit union division, so we do have a dedicated staff and team that work only with credit unions and customize everything that we do to the credit union network. We are also a partner with the GSEs and of Acuma, and are the leader in digital appraisal modernization, which was one of the topics today for the transformation of the appraisal process. This presentation will also be made available to you. You can download a PDF version of it in the Resources tab. If you are unable to do so, both ourselves and Acuma will make this available on their websites, both in written form as well as the slides and copy. All right. With that, we're going to just hit our agenda real quick, and then we'll get into the meat. Really, this is, as I said, these topics that we're going to go over today, they're all coming in the case of the ROV process, 1 month, all the way to the next 12 months. So there's a huge amount of transformation that is occurring in the appraisal space over the next 12 months. And all of these topics are part of that. And they will all affect every one of your credit unions. Whether you do secondary market lending or portfolio lending or both, you're going to see these changes hit you across the board. So we're very pleased to be able to have these great people to help illuminate that. Each of these topics, as I mentioned, is a webinar in and of itself. We could sit here and do an hour webinar on every single topic here. So we're not going to do that. We're going to give a high-level blow-by-blow with some resources, and then we'll obviously be available for help and questions after that. So we're going to talk about appraisal bias, which Sally's going to kick us off with, the new ROV process. We're going to go over that very briefly. Most of you probably are already moving toward finishing or finalizing that, but just to cover it for those of you who are still having questions on it. The new URAR appraisal report is a huge topic. There is a new appraisal report coming, and it will deprecate and replace all the other forms over time. So very important topic for you to understand and be aware of. And then, of course, we have the hybrid appraisal, which is coming in the first half of 2025. So with that, let's just jump right into it. Before we hit the topics, I do want to open it up for some questions for Misty and Eric. I think it's very important that you guys are able to input on these topics, so we really appreciate you guys joining. And I wanted to start off with you, Misty, and just, you've had a lot of experience doing digital with your membership now and having done hybrids and PDRs and PDCs for a while, but could you just describe, first of all, just the importance of the member experience and the way this has happened for your credit unions and your members?
Absolutely. So we really work here at One AZ to be trailblazers and to improve the lives of our communities and our members. And we try to be a very early adopter for the property data collection. And I will share with you that we went through the struggles in 2021, 2020, 2022 of the extended delays for appraisals. And one of the pieces for that property data collection that has been a huge lift for us, for those that receive that opportunity through the Fannie Mae AUS findings, is the time and the cost savings. And it's been absolutely a benefit to our area just because of how competitive the market is for purchases. So for our members, reducing the cost, not needing a full appraisal, and to be able to have that collection come back within a matter of, a couple of days instead of up to maybe a week has been absolutely instrumental in us being able to have really short closes and turn times for our purchases. And in a competitive market has made a big difference for our membership.
No, that's great. I really appreciate you sharing that, Eric. How about yourself as well? I know you've been on this journey as well, and so I'd like you actually to talk through on the third question there in terms of board approvals and process. But could you share on the first topic as well, and just in terms of member experience?
Yeah, obviously the member experience is the key to making sure that our transactions go smooth. We adopted the AVMs a number of years ago and just kind of slightly into some of the hybrid reports. When we were with True Union before, we used a lot of the abbreviated evaluations. We face a lot of kind of rural areas in our market here in Chattanooga, so it's a little tough for us to be able to use the AVMs or the hybrids because we serve in basically 2 states, but we border multiple more states. So it's been a little bit difficult for us to adopt that fully, but we still try to make do within the more metropolitan areas that we serve.
Yeah, absolutely. And I think one of the topics we have coming up here with respect to the hybrid appraisal is going to be a big help to that. As we all remember, I think Misty alluded to it in her comments, 2020 and 2021 really broke the appraisal capacity piece of the industry. And the first thing to go typically when they get busy and the volume is there, and it overstresses the appraiser capacity is the rural areas. We see those turn times go from 6, 7 days or 5, 6, 7 days out to 10, 12, 11 days on a traditional appraisal report process. So the hybrid does have a huge role to play in that, and it hasn't been available widely before. So the fact that it's coming is now going to be a big help to you on that. Could you pivot over to board approvals? There are credit unions that are on this call that some of them I've talked to a few of them at the Acumen conference as well, who really would like to embrace modernization, see it as a benefit for the member, but they're facing, how do I talk to our compliance folks about this? Our board maybe, decades ago approved, we can only do appraisals on any type of transaction, and they don't understand what this stuff is. How do you sort of work through that with boards, with management, senior leadership?
Yes, Mark, thanks. So here at TVSU, the real estate department and the mortgage lending team that I work with directly, we're responsible for our policies and procedures. We do have them approved by our board, but they make us, kind of go through all the particulars and work with all the details. And it's funny, they don't like acronyms in this business. We have hundreds and hundreds and hundreds of acronyms. So, but we as the subject matter experts take that information to them and say, look, even a few years ago when the limits raised for the different types of evaluations that we could use, we are explaining this to them and why this is going to make this a faster process for our members and for us. We could have the capacity to do more loans. It's really just education. I think from my standpoint, it's letting them know and understand what we're doing, why we're doing it, what's the risk to it, and how do we make safe, sound decisions and keep the credit union safe and sound. We don't really get a lot of pushback. We may get questions, but it's more so, hey, you're the experts. You've vetted this through your compliance groups. We have an external compliance attorney, as well as another external firm that reviews a lot of our procedures and policies related to real estate and mortgage lending. So it's really just making sure that we have all of our ducks in a row and that they know and understand what we're doing, and they trust us to do it. And I think our numbers speak to that.
Oh, great answer. And same question to you, Misty, with a little different twist. Bring in the real estate partner here, right? So it's one thing to say we want to do modernization, do proper data reports, do hybrid stuff, but you have realtors on the other end. You have members who maybe like, all I expect is an appraisal. This is my 4th home transaction. Wait, what? No appraisal? What are we doing? How do you bridge that gap?
That's a great question. And I'll just echo what Eric said about education. we have found that for our mortgage partners here internally, we have helped make them very educated on what this is, that it's not a valuation. So they really thoroughly understand
Training.
what
Yeah.
the collection is. And then we can explain that to our membership and help our members understand this is a benefit to you. You know, this is the cost is very beneficial for you. The turn time is beneficial, but here's what you're actually getting. And when they understand what it is, we've had no resistance from members who've been able to use that modernization for a property data collection.
That's awesome. Great to hear. And on that note, we're going to talk about appraisal bias. I'm going to let Sally address that one in our coming slide. But talk one more time, if both of you could, to the underwriting side of this, because that's another sometimes not a pushback, but a concern that we sometimes see out there. Hey, before I had an appraisal or appraiser doing a report for me, and it came back on the 1004, and I pretty much just had to underwrite that. Now we're looking at our underwriters looking at something completely different. They're looking at digital data, 20,000 photos, virtual tours, all sorts of stuff that that we're now generating and saying, in place of an appraisal, this. How do you bridge that gap with your underwriters, and what have you found to be one or two nuggets that our credit union partners on the phone can take away?
I would say for us, Mark, that, it was, we had to kind of, dip our toe in the water and get that first one done so that we had something to educate and train them with. We've got some very seasoned underwriters and an underwriting manager that have come from outside the credit union space and have a lot of secondary market experience with these different types of reports. And so we really relied on the subject matter experts again there to be able to teach our other underwriters, as well as even our originators, our processors, and some other members of management to be able to read these and be comfortable with them. And so, kind of once you've done that first one or two or three, then it's just like seeing a regular report.
No, great point. Misty?
I would say very much the same for us in terms of the, subject matter experts being able to train to this. I think really understanding that this is no longer an appraisal, that there's not a value that's being given in an appraisal report. That was probably one of our biggest challenges, to understand that this is stated value with the collection of the data. And I think once we overcame that, having a few examples has really helped. I'll be honest, I think the other piece is the partnership with class. When we have a new situation that we're not familiar with, being able to ask a question has been really helpful for our underwriting team, and them just, knowing this is new and they may not be certain, and that's okay, and we can figure it out. And that really, just having that openness with our mortgage lending environment has made it possible for us to proceed as well as we have.
No, excellent feedback. Thank you for that, and really appreciate it. So let's pivot now. And by the way, while we have a few more people who've joined, so I will just reiterate, all these resources will be available after this webinar. If you have questions for Eric and for Misty and for Sally or for me, please do put them in the chat. They are being monitored, and we will have them answered during the webinar as we go, because I know questions will come up. With that, the topic of appraisal bias has been a very hot topic, and it actually kind of encircles all of these modernization changes that we're doing. So there's some positive impact to be had there. But Sally, could you just give us a framework here for appraisal bias and how it's going to be impacted by these technology changes and how it impacts the technological change?
Yes. Hello, everybody. So the appraisal bias topic is a really scary one, I think, for our credit union partners. And it's getting even scarier. And it's a relatively new topic. It started probably in 2020 with a couple of newspaper articles which highlighted borrowers who had felt that their houses had been underappraised. They whitewashed them. And then that uncovered from there a lot of research and a lot of data that was out there, and really kind of came to prove that there was some overall bias, and maybe implicit, explicit, we're not quite sure, but it's a huge topic. It is also now really out there for everybody to know about. So I was telling one of our credit unions today in Colorado that if they go into the Denver airport, there is a message up there. If your house is being underappraised, contact HUD and, that kind of thing.
I
So
saw one of those in Dallas Airport.
did you? Yeah, yeah. I mean, it's there. And so in the public domain, people know about it. And, I didn't hear any kind of chatter about it from our credit unions as far as having members, actually voice complaints or potentially feel that they had been discriminated against. We were just really taking action to do training and that type of thing. But now I'm hearing every week a credit union is coming to me and saying, we have a situation where our member feels that they've been discriminated against. And mostly they come to me when it isn't one of our appraisals, which is really nice. So I'm kind of happy about that, but I'm sure I'd hear about it if it was one of our appraisals. So the appraisal bias, there is so much information on this out there, and I do a training for credit unions, and I do webinars and talks on it, and I've done a lot of research on it. But in a nutshell, a lot of the modernization that we have in the appraisal field is really kind of being pushed by this appraisal bias thing. And the idea is that we can somehow managed to get for everybody's members and for the credit unions an unbiased value opinion, a value opinion that isn't subjective, it's objective, and it's supported. And sometimes, with the value acceptance, the GSEs are able to do that. They have enough data to be able to run whatever model they do, and they come up and say that we accept that value. We don't have to go any further as far as an actual appraisal. So then we get into kind of things of really trying to mitigate some of the bias out there. And I think obviously a property inspection takes an appraiser out, but also taking the appraiser out of the field with a hybrid. And that's what should happen. Really, we need to free up appraisers to do what they're supposed to do, which is appraise. And I think that it will improve turn times, but also mitigate bias. As far as preventing appraisal bias or trying to mitigate it, there are so many parts of this that we have to kind of look at, but and some of them involve the appraisal industry. We have an appraisal industry that is incredibly, it's not diverse. We have 97% of appraisers are white, and actually most of them are men. And we really need to diversify the profession, but that will take ages, based on our training. But what can we do right now? Well, training is one thing, but also being able to recognize subjective data in appraisal reports, training our vendors, training our appraisers to make sure that we don't have it. Adding policies and procedures and being able to have AI for keyword searches, to make sure that an appraiser is not putting something in there that is potentially misleading or subjective. So there's a lot of things that can be done, but it is being pushed by a lot of the GSEs, the CFPB, DOJ are taking actions. We're going to see some appraisers that are going to go before their state boards on this. In fact, they probably already are. One thing that has successfully come out of this push for to try and mitigate the appraisal bias is the ROV process, and the push by the GSEs to have some control, some policies and procedures around the ROV process. And really, this is fantastic. And every other profession you can kind of somehow argue in an appeal version, right? If you are, we have appeals in the legal sense, or if in the medical field, you can get a second opinion. Why on earth shouldn't we have some kind of framework around that in the appraisal field? So I think the ROV process is going to be very good. Again, that's something we can talk about forever. But it does come out of the appraisal bias side.
Well, most credit unions that I've talked to have a policy in place or are trying to put one in place or finalizing one for ROV. There's a few that are still trying to finalize it, so we'll touch on that a little bit in a couple of slides. But I wanted to bring it back to Misty and Eric too, just on that last point about process and policy. So obviously, I think it's important that every credit union vet their vendor, right? We as vendors have a duty to you to be able to articulate how we are rooting out appraisal bias, what our frameworks look like for QC management of the appraisal, and all of that. But internally, can you just share with the credit unions that are on this call how you guys have either started putting policy in place around this or how you're thinking about just having something overarching so when an NCUA auditor or anyone else walks in the door, you can produce like the receipts to say, here's how we proactively mitigate it. Misty, you
Yeah,
can start with on that.
yeah, I'd be happy to speak to that. So we've had a policy and a process in place, honestly, for years. When the GSEs came out with what they were expecting, it was very close to what we already had in place in terms of our members being able to submit an ROV. We've had a form for them to fill out. I mean, we've really worked hard to be proactive in this space. We probably don't have as much rural area as Eric does. We definitely have some, and that's certainly a consideration because, like Sally says, the appraisals are subjective. And so we definitely have opportunities here for our borrowers to have questions or think that what they've received is unfair or think that there might have been some kind of a bias. And so for us, it's been really easy to kind of transition to what the requirement is because we already had that in place, wanting to be a credit union that is very proactive and really member centric.
Does the ROV process give you that opportunity up front to do that, or do you have a separate document that you also go over with a borrower in addition to the ROV process talking about appraisal bias?
So we haven't had the disclosure up front. We have something after the fact, and we've done a lot of training with our originators and with our processing teams, those who are member facing. So that disclosure will be really helpful. So we are a little more upfront with that process. It's all been after the fact, but because of how hands-on we tend to be and how member-centric, the conversations around that, we take every concern and every situation seriously and have for years. And so, but for us, it's all been the actual ROV, not the information up front in a disclosure. So that has been a good add for us to be able to address that right from the beginning, that this is an opportunity for them before they get the appraisal.
Great input, Eric.
Yeah. Yeah, so I can remember, I think it was 2021 or so, I made a call to Sally late in the afternoon and I said, hey, we need help with an appraisal bias policy. And she walked me through, this was kind of when, you were saying it was around 2020. A lot of the verbiage around appraisal bias started really coming to the forefront and there were some cases already coming out. And I was like, yeah, we might be a little bit behind on this. So I can remember that call, vividly about, hey, we really needed to implement something. So she walked us through it. And now we have a 19-page policy and procedure set on appraisal bias and the ROV process, like Mark and Misty, you were just referring to. And so we do now. We started providing that disclosure upfront with our disclosure packages, and we kind of just follow what the guidelines are from the agencies about the process, and it really talks to all of that, and it really just letting them know up front that there's an option for this, and then logging it. And for to your point, Mark, about the audits is, hey, we've got something right here, and we say we've done this many this quarter, or these 3 quarters, or this year, whatever the scope of that audit is, to say, hey, that we're really on top of this. So
yeah, prepping yourself
Yeah.
ahead of time for it.
Didn't you, Eric, have an auditor actually ask you for your appraisal bias policy?
We did. So yeah, so year before last in our NCUA audit, the auditor that we were assigned for the lending side, it was his first year auditing for the NCUA. He came from the the OTS, and didn't even ask to really look at it. He just asked if we had it. So I went ahead and sent it to him, and he said, you're ahead of the game more so than a lot of other credit unions. So whether we were or weren't, I think that's irrelevant. We actually had something in place, and we'd had it done before the auditors asked for it.
I was going to
That was
say,
a win for me. So
since you spilled the beans on your 19-page policy, I suspect you're going to get some incoming email from some of our attendees about wanting to share that. So
happy to be collaborative.
for sure, and that's what we love about the credit union space. So let's kind of move to a similar topic, and it's related to the ROV, but this is something we got a ton of questions on. at the Acuma conference last week, and so many of you, I think, are probably already seeing this too. It relates directly to this topic. And so that would be the new quality control standards for automated valuation models, new rule. That's the name they gave it. I didn't give it that name, but I guess people sitting up there need to do something with their time, and that must mean creating big names like that. So there is a link, obviously, in this, so we'll be sending it to you if you haven't already read it. I would encourage you to go through and read it. It's not that long, but it's pretty dry, but there are a few highlights. So I wanted to bring those out. Just to kind of start off for everybody, this is appraisal bias monitoring coming to AVMs. So we've all used AVMs. We have a huge AVM component at class, right? We have home equity lending, portfolio lending, a lot of alternative products, alternative valuations that are based on AVM, where we will either have an AVM standalone or an AVM with an inspection, or even an AVM paired with a desktop quantitative appraisal or something, where you just have a lighter, cheaper, faster product, but the value is primarily based on an AVM. The interagency adoption of this rule now basically says that these AVMs need to adhere to the same types of policies, practices, and procedures around non-discrimination and conflict avoidance that appraisals do. So you can read the rule, but here's also kind of the 5 pieces of the new testing standards. The last one there, comply with applicable non-discrimination laws. This kind of the way it's been written, it sort of puts it squarely on the lender, even though as lenders, I think, have made a great point of saying, look, we don't control AVMs. We just order them. I hit a button, I order it from class, and wherever it sources from, that's when we get the AVM. How are we supposed to do that? Nonetheless, you have to do it. So we wanted to give you some recommendations for this, just a couple of light recommendations. First off, how do you comply and make a policy around these changes? You do need to make and document your own policy. So you don't want to just rely on the policy and P&P we send you, policies and procedures, right? We will have to send you something like that as a vendor. All of your vendors will have to do the same for you. So you should be asking those questions about how do they test, review, and sample their AVMs, or if they're reselling someone else's AVM, how do they get the testing documentation from that source provider so that you can have a copy of it? You will still then, to Eric's earlier point, you will want to include or update your appraisal bias policy to include something related to the AVMs and saying, look, we don't just sort of autopilot AVMs here. We do talk to our vendors. We do ensure that we're getting some type of regular semi-annual or annual update from them regarding the testing that they do for their AVMs. One last one there. How can you determine monitoring for an AVM for non-discrimination? Okay, this is really, really technical. I've been in this part of the world for a while. We actually, for example, at class, we use collateral analytics base for our AVMs. So there's actually a really great set of resources we have, and even a couple of webinars I can point you toward where we really dig into this topic. So I would encourage you to email me after the fact, and I can point you in the right direction. Some of these providers that we use are pretty universal in the industry, so it'll be a really good topic for you to just look at. But if you want to just get a quick answer, kind of give it to you in this little blurb here, what AVM providers do to really start monitoring for non-discrimination. One of the big things is they actually break out census tracts. And then using that, they block out the census tract and they actually assign the percentage or levels of minority coverage versus majority, white coverage, for example, in those census tracts. And then if they determine, for example, one area is, largely white, another area is maybe largely Hispanic and African American, they will run AVMs in both of those places and start comparing and sampling results against them to see if the AVMs really are treating those homes differently, right? That's one part of how you do this. That's a very high level answer. There's more to it, obviously, but there is a pretty big initiative right now underway at most of the large AVM providers to do exactly this. So having this documentation is really important, and you should ask for it from any vendor that you have. So I have the question for you guys. I think you guys answered this question earlier and how you're applying the policy around the change, but we'll just kind of add to that and move quickly to the ROV process. So you both explained your ROV process, I think, pretty well. Just to high level this for everyone, these are the high level rules here that you have to kind of follow. So one ROV per loan. This is borrower initiated. They have a limit now of 5 comparable sales. So it used to be sort of unlimited or not prescribed anyway. Now, you know, it's a hard and fast sort of 5 is the max. You must define timely manner. So appraiser has to respond in a timely manner and address these issues categorically. But you as the lender are the ones who get to define what timely manner is. So if that is in your ROV policy, you should definitely look at doing that. Just to give you some feedback, most of our bank and credit union clients are picking either 1 week or 2 weeks and saying, you know, giving themselves time to send an ROV through to a vendor like us. We have to go and send it to an appraiser, work with them. There's back and forth. Maybe even an inspection of the property has to occur again. Whatever. You want to provide all that time, and then we come back in, get the report, review it, and get it to you, and now your underwriters are reviewing it. So when you look at the totality of that process, 1 to 2 weeks is probably a good timely manner to spell out in your policy. And anything else, Sally, that I may have missed here that you want to kind of top us off on?
So, yeah, I'm obviously going to come at this from the appraiser point of view. As the appraiser, so one really important thing I think is that that there is some kind of there are guidelines around this, and really an incentive for appraisers to really take these seriously, and to act in a professional way when they respond to an ROV. We've all seen the kind of responses, you know, that some appraisers, but like I said in my original report, or if if they're blind, don't they see this, or whatever, you know, that some appraisers.
The snarky comments, yeah.
Yeah, the snarky comments. So I think that we will see these addressed in a far more professional way, which is really, really important. The other thing is, you know, there's no charge for them, right? You can't, you know, this thing of appraisers saying, well, yeah, I'll reconsider, but I'm going to charge you another $500 or whatever. You know, that has gone away. They cannot do that. So I think that from an appraiser, you're going to see a better, you know, result. The other thing that I think is going to be a little could be tough, it's already there, but the mandatory reporting that comes out of this, that if you because you have you decide that one appraisal is flawed and you're going to order a second appraisal because the first one's unacceptable, you have to report the appraisal on the first one to the state regulatory agency. And that actually already does exist in Dodd-Frank and everything else, but it kind of has been brushed under the rug a little bit. So it's bringing that back up again. So we're going to see how the state agencies are able to cope with that. And see if that's going to increase. I do not think one fear from a lot of our credit unions is this new ROV policy will increase the amount of ROVs. I don't think that's going to happen because, for one thing, we're kind of taking the realtors out of this, right? It used to be, I know Eric's had this situation where we've had the realtors who decide they're going to instigate an ROV. So we're limiting it now just to borrowers, just to your members. So I think that's really important. And I think putting a policy around it probably kind of really legitimizes it, and I don't think we're going to see a huge increase. I did have a credit union that asked, is this going to put up the price of the fees on appraisals? No, it isn't. That's not going to happen. The other thing that's incredibly important is this limitation of 5 comparable sales, and they have to be sales. They can't be listings. So we all had situations where people would just do the realtors would do a run of sales, right? And hand you half the MLS listings to say in support of the value. So that's gone away. So it's good. This is going to be a really good thing. And as far as timely, like Mark says, 1-2 weeks, we need to give the appraiser time if they have to do further research, and keep that pretty, don't limit yourself to hours. I would say go for weeks.
And on that note, for those of you who are using other AMCs, other vendors, right, that you're out there and you've got vendors like us, communicate your policy and your final timely manner to your vendors so that we know how to manage against it too. That's always helpful. Policy comments from Mindy and Eric, I think would be great to kind of just get a little on one of the points that Sally made. In terms of the policy itself, right? How have you guys gone about creating that, and how are you managing the notifications that are required to go to the borrower before and after the receipt of the appraisal?
Yeah, so Mark and Sally, if I can just want to say, I want to go back to the fifth bullet point there where the lender is responsible for ensuring that the ROV
Yes.
is legitimate. Sally kind of touched on the fact that in the past, maybe real estate agents were the ones driving this. But there's nothing really says that once we send this to our members, that they may not enlist the help of a real estate agent. Now, it may be
Right.
coming directly from the member, but that's where the legitimate part comes into play, because we all know that there's this big, huge, headbutting, vast difference between what appraisers appraise like and how they, conduct their review of the line item adjustments versus, the real estate agents thinking that everything is included into the square footage when it's not. And, we could go on for days about that too. But really vetting it once it comes back in, vetting the sales and making sure that what you're providing back to the to class or to your appraiser, that it's legitimate and that it should be reviewed. And if not, it should be sent. So I think that's important to point out for our audience here today that it really needs to be vetted heavily before it's sent and not just kind of randomly sent
Yeah.
each and every time with no review.
Very good point. And that's why policy is important, and documentation, to your point, is important. I did see, I think, Gabby and Christy raising their hands in the webinar. So I just want to encourage everybody again, just because of the time and the constraints, we're not unmuting the attendees, but you can type your questions for us right in that chat, and we will definitely get to them and appreciate that. Moving on, since we're kind of at the 38-point mark here, I want to make sure we get to the last two topics. So digital appraisal. This is kind of our big next move, okay, for the valuation industry. It's expected into policy in 2025, so I call it digital appraisal. It's really the hybrid, right? It's the idea of, if you want to think of it on a basic level, think of the property data collection, the PDR and the PDC that we are currently all using for inspection-based waivers right now. Imagine just taking that and adding an appraiser to it and saying, okay, here you go. Here's the data, right? And you do an appraisal based on that instead of inspecting the property. That is essentially what a hybrid is. So the hybrid's been in pilot for the last 4.5 years at this point, I think. Class has been one of the four primary companies in the pilot. We've done probably more of them than anyone else in the industry. They work really well. The results have been fantastic, and the GSEs are very pleased, I think, overall with the way the pilots have gone. So a lot of testing. About 250,000 plus hybrid appraisals have been done in the last couple of years, and the results either mirror or exceed that of 1004s in virtually every category. So with that, and with the expected appraiser capacity issues that are going to happen next year, the digital hybrid appraisal will come into policy. And as it comes into policy, how do you start adopting and using it? And just as a quick reminder, I think I shared this slide back in another presentation, but I'll recap it here. This is a fun one. Freddie Mac is the source data for this slide, but they do put out this unique licenses versus volume, and they update it very regularly. So you can see what's been happening with the appraiser capacity as we've gone over time here. You have refis and purchases are these colored parts of the graph. The gold line running through that's the number of unique appraisers doing all appraisal reports in the UCDP. When you consider that about 91% of all appraisal volume in the country is driving through Fannie and Freddie, this really gives you very good context for what's happening with the appraisal industry, the appraiser shortage, the aging of the population. This is why modernization is coming into play. It's so that we don't have things happen like 2020 and 21 where the capacity blows away that gold line so fast and so hard that we're all stuck with weeks long waits on appraisals. So right now, these appraisers can handle the capacity that we have in the industry. That's why most EMCs that you're working with can turn around an appraisal in a decent amount of time. But as things change and as we get any sort of rate environment positive increase or anything like that that causes production to go up, that gold line is going to start getting stressed again. So that's where the hybrid process does allow for an expansion. It's also why we have the inspection-based waiver. So just a real quick overview of this, and then we'll get to Misty and Eric on some thoughts on how to incorporate these things. You have 5 options in appraisal modernization essentially now. You've got your value acceptance and ACE, which used to be called your property inspection waiver or PIW. That still exists. It didn't go away, contrary to some people's belief. But it's only a small percentage, right? There's very, very few percentage-wise of loans where the GSE will tell you, you know what, we need nothing, just send the loan. Most of the time now, when you're seeing the waiver, you're seeing an inspection-based waiver, something we call an IBW. Misty referred to it earlier. Value acceptance in Fannie Mae world with property data, same thing in Freddie Mac world is called ACE plus PDR. Here they are telling you no appraisal needed. We know the value, we're good with it. Your contract price, your purchase price, your whatever, your loan amount, we're using that, it's good. We just need you, credit union, to go ahead and verify the condition of the property. You do that by getting a property data report. So, you know, we have a standard flat fee for all of these around the country. It's $275. And you're able to just order that on any type of condo or single family, and you get that property data report. We even submit it to the GSEs for you, so there's no work on your part. It's just done, and you can move forward. When you move into an appraisal scenario, then the hybrid appraisal is really where the end game is. This is where you still see traditional appraisals. Those are not going away. As Sally pointed out earlier, there's still plenty of properties where a traditional appraisal will be needed. But a lot of appraisals, and I think we all know this intuitively, if you were to send, you know, 8 out of 10 orders to us at class, especially if they're in suburban and urban areas, 90% of the time, the appraiser already knows what the value is when we assign the assignment to them. They're already pulling in their research, selecting their comps. They've been in the area, they've seen that neighborhood before. They kind of know where it's going to land. They're really just going to the property to verify that it looks like the MLS photos, there's safety and soundness, you know, issues that are mitigated and all the rest of it. So when we're able to bring that to them, instead of having them go there, that inspection time, that is really what takes up and chews up a lot of the appraisal process time. That's what goes away in a hybrid. We're able to do these whether it's busy or whether it's not busy. You still get the same kind of turn time, same level of veracity and quality. Just to kind of visualize this for you, and for any of you who'd like an actual demo of this, we're more than happy to come offline with you and show you the actual tech and how it works. But this is a good example of a screenshot. You can see kind of all of our AI and enhanced QC in this shot where we're collecting the imagery of this room. We're confirming, you know, all the fixtures, the type of quality and condition rating is in. This one scan of this room is producing about 900 photos that we give to an appraiser. On average, one data collection that we do on a house of exterior and interior produces about 20,000 HD photos with a 360 virtual tour, with an appraiser grade floor plan, with all of the property data elements that Fannie and Freddie need. So the appraiser has access to a vast, vast amount of information and is able to do an appraisal using that from the comfort of their desk. Sally, do you want to speak to that just in terms of how appraisers adopt that too?
Yeah, I think what is really important to understand is when an appraiser is going out to do an inspection for their appraisal in a traditional sense, they're not doing this level of detail. I can tell you that they're, perhaps still using a measuring tape to measure. They are maybe using a laser, but they are really doing an inspection to verify the condition and quality for the appraisal. And it's not a condition report in itself like this is. So the kind of normally I think an appraisal report is about 40 pages long, something like that. One of these PDRs are actually 40 pages long themselves, and you add that to a hybrid. So these hybrid reports are, sometimes 100 pages long. So they are very detailed. I love the fact that, they have the kind of the technology that they can scan appliances to say how old they are and things like this. And it is just it's incredible and a lot more detailed. So I think that, if I was an appraiser doing field work or not doing field, I'd love to do an appraisal based on this. I think it's great. Absolutely fantastic. One of the things that some appraisers say, what about the neighborhood? How can, when somebody else is doing the inspection of the property, how do we know about the neighborhood? How do we know about, what is happening there? Well, the fact is we're using geographically competent appraisers, so they should know their neighborhood. We have access to all kinds of technology now to be able to walk down the street in a neighborhood actually virtually. And we know where any externalities are or anything like that. So I think that at this point, our appraisers know their neighborhoods, their markets. The only thing that if they don't go to the property, they don't know is the condition and quality. And this is a superb kind of rendition of what there is.
Eric and Misty, with this sort of being the backbone of the property data collection that we're currently doing on inspection-based waiver, and now soon to be the backbone of these hybrid appraisals, just from an underwriting standpoint, can you guys comment for the audience out here, just in terms of when you guys are getting something like this, where you're able to see the 360 tour yourself and access all of these photos too, just like the appraiser can, what does it do to lift the veracity of the collateral underwriting component of the loan when you're able to see all of this?
Definitely increases the confidence of what the review is because of how much information is available. This data collection, like you said, I mean, 900 pictures is way more than we're going to see in an appraisal. And being able to see all of that, I think, increases our confidence on our review and our acceptance of the collateral.
Yeah.
Yeah, and I think this is more robust. If you think to like a Zillow or a Redfin or a Realtor.com, you're seeing these, walkthroughs on a kind of a lesser scale. So
Right.
you can get
Yeah.
familiar with it that way. You can just get it right in your report and be done and not have to go to multiple sources to look at this. So I think, again, like Misty was saying, it increases the confidence of being able to underwrite it and feeling comfortable with it. Just the standardization of it, the timeliness of it, it's all right there at your fingertips. It's easy.
Yeah, it does address appraisal bias too, in a sense, right? Because the appraiser is not going to go interact with the homeowner; they're interacting with the property.
Right. And I think one important thing to kind of, when I look at these, to add a kind of an appraisal term, a USPAP term, we had this thing called an extraordinary assumption, and it was basically where appraisers have always been able to say, well, if I don't know, I can have an extraordinary assumption. Maybe it's this or maybe it's that. There is no extraordinary assumption on these hybrid appraisals. They are totally relying on this inspection, and I think that's really important. It's that this is. There's no hedging on it. In other words, they're relying on it, and so these inspections have to be good enough to allow that appraiser to do that. And these inspections have been developed, with the GSEs, with the GSEs input. So realizing that we have that confidence of them, I think that we both as appraisers and as credit unions should have confidence in these.
For sure. There is a question from Colleen. Is the hybrid appraisal going to be now required for all Fannie and Freddie loans in 2025? No. It will come into policy. It will be in selling guide, and you will see it when you look at your AUS approvals. You will see it alongside the traditional 1004 on loans that are eligible for the hybrid. So you will then have a choice to be able to say, I could do a hybrid, I could do a traditional. On some loans, you may even see multiple. You might see, oh, you can do a PDR, PDC, inspection-based waiver, or you could do a hybrid, or you could do a desktop, or you could do a traditional. You pick, right? And so you would obviously start with the cheapest, fastest one, which would be the inspection-based waiver product, and then you'd kick up from there, right, as you needed to. But there will be a number of loans that come out, right, that don't have PDR, PDC, or inspection-based waiver. They're saying we don't want to give it a value. We want an appraiser to give it a value. Here's your two options: hybrid or desktop, or traditional appraisal. You have the ability as the credit union to say, okay, which one do I want to pick? You could reach out to us and go, hey, what's the turn time going to be for traditional? If I say a week and a half, but I can do it in 5 days, if we do it with a hybrid, you might say, let's go for the hybrid, right? And we could do that. So there's definitely going to be some options for you and some play in there as this comes out. I do want to land the plane real quickly here on the new URAR report. We are definitely not going to go into this in great detail. We did talk about it. So I do want to just kind of give everybody some resources for it, and then we'll get to Q&A. The new URAR is coming. It is a new appraisal report, a universal report that combines the single family condo and multi-unit into one report that can do it all. So if you're a nerd of the rings kind of guy like me, one report to rule them all. That's what it is. Okay. The forms, therefore, are going to be deprecated, right? So when you're looking at 1004, 1073, and all of that, they will eventually be deprecated out in place of this new report. This report is expected to drop sometime in the middle of next year. The lender testing period for this is beginning Q4. Fannie and Freddie have already released some great readiness kits for it. So I put those links in here for you. If you have not seen the new appraisal report, definitely click on that Fannie Mae Lender Readiness Kit link there, and you can go to their website. They have a great site full of information in detail, and you can even download a couple of the samples and take a look at them. What you'll find is that it's going to be very gridded like this. It minimizes the subjective commentary. You know, if you think about the traditional form, right, that we're all used to looking at, the 1004 and the 1073, there's like 1 or 2 pages of sort of gridded information, and then beyond that, it's a bunch of typing, because there's no place for, in a lot of them, for the appraiser to really tell you how did they arrive at their adjustments and how did they do this or that on the report. This form report here is going to give them all of those options, and for you, it'll be much more readable, much more organized, and digital. So I've had over the years, like when we've integrated with an Encompass or another LOS, I always get the question from our lender partners, hey, how much of the appraisal data can you pull out and auto-populate into my loan file for me? Like, we can do some, depending on the LOS, right? Some basic information, some more. But something like this, we could pull every field out, and we could map it wherever you wanted it to go. So it's really, really cool in that respect. It's going to enhance clarity and reduce bias, but it is going to require some training. So let's just kind of end off on this. You know, there's, for those of you who are self-managing appraisals, there are some of you on this call, I know. We own DataMaster, which is one of the 5 major appraiser software companies. So we're already building out this URAR in our software. We can help you and help your appraisers walk over the bridge. As Sally and I sometimes laugh about it, you know, appraisers love change. So this is going to be a great thing in the next 6 months to watch this train wreck. But we don't want it to be, but we don't want it to be that way. So we are taking a lot of proactive steps at Class, both with industry training, as well as creating the tech, as well as putting in our appraiser software. And then we're going to be training our lenders too. So Misty, we talked about this in the run-up to this call, but if you want to take that middle block there in terms of training the team, some of the considerations for your team that you've already started looking at.
Yeah, we've since we primarily use Fannie Mae for our investor. That's our secondary market partner. We've already looked at some of this documentation and are going to be setting up trainings for our underwriting staff so that they can feel confident with what this is. I think we're also very interested in how our integrated system with our LOS and how our LOS is going to work, because I think we're going to have some work there to make sure that what we currently have can stay or be better, like what you were talking about with the technology transfers from the form into the system. But I think a lot of it's going to be just being familiar with the document, because it is quite the change. I was at this credit union and helped with the changes from the CFPB for the disclosures when the CD and the LE changed. So I think some of that's going to be a really similar kind of training where we just learn to familiarize ourselves with what's changed and what it looks like now, and let go of what it used to be. So
100%. Eric, you know, we talked about the technology considerations, so I'd like you to take this, because a lot of times when we're talking about a new appraisal form, we think of it in a single thread of what are the appraisers going to do and how's my AMC going to work. But what are some of those other considerations regarding the LOS that you'd recommend that credit unions take on this?
Yeah, really just staying on top of your LOS provider. We know there's only a few of them left, but just making sure that they are on track to meet the deadlines, if not ahead of schedule, so that you can do proper testing to get the data back and forth from your AMC. Hopefully that's Class, and just making sure that it works. Same way with the ROV process. We use Encompass, so we send that document out through there. Now we have to send it back through Class, but being able to integrate that into our disclosure package. So, you know, again, just staying on top of your LOS and making sure that they're ready to go, making sure that your teams are ready to go from a training standpoint. And I think it was kind of mentioned, you know, the document looks very similar to the LE, the CD, and the new application. So it shouldn't be that hard to train, but it is something new. And a lot of times credit unions are a little slow to adopt new things. So start now, don't wait, and be ready for it.
You know, one thing I do also want to add that, you know, in consideration of these new forms, this new form report, as I call it, of course, it will go to your member too. And I think it will be a lot more understandable for members.
Much more easy to read.
Rather than what we have right now. I think what's done right now is very confusing and there isn't really any consistency. So I think we'll find that this new report is going to be far more understandable for your members.
That was definitely one of my first observations, since I tend to be the primary party who talks through questions and concerns with our members about the appraisal, and reading what currently exists is not very borrower friendly. So I was really excited to see the changes because they are a lot more clear and certainly easier to explain as well. So
Yeah.
I think that'll be quite the lift. I'm glad you said that, Sally. I totally forgot about the observation I had before.
Yeah. Well, guys, we've reached the 1 hour mark here, so I want to land the plane and bring Cameron back in as well, and thank her and Acuma for the opportunity to be in front of you guys, provide you this information. Really hope you found it valuable. I'm just kind of scanning through the questions here just to make sure there's no other questions that we didn't answer. Yes, we're Meridian Link partner for one of those questions, and a couple of people raised their hand but didn't ask any questions. So feel free to follow up with us on an email. More than happy again to provide these resources and help walk you through these changes over the next few months as they start hitting and coming out. Glad to be a resource, and really want to thank Eric and Misty for your time today. You guys are very busy running lending operations and doing great at that, but really appreciate your time too to come in and input and help your fellow credit unions absorb this information. Thanks so much. Cameron.
Thank you all, Mark, Sally, Eric, Misty. This was great. So thank you again to class, and I hope everyone has a great day. If you have any questions on the resources, feel free to reach out to me as well. Thanks, everyone.